Welcome to the Deep Dive. Today we're digging into a financial strategy that honestly sounds almost too good to be true, but it's been how serious wealth gets built for generations.
Right.
The basic puzzle is this. How do you live that high life? Buying houses, funding businesses, taking trips, without ever actually selling your main asset, the one that's hopefully going way up in value.
Yeah, it really pushes back against that old idea that you need a massive salary, that huge W-2 income to be truly wealthy.
Exactly.
And the strategy, it's known as buy, borrow, die, or BBD. Traditionally, this was, let's be honest, mostly for the super rich with assets like big real estate holdings or private company shares, stuff that's hard to sell quickly.
Right, illiquid stuff.
But what's fascinating now and what we're diving into is how BBD is kind of being democratized. It's being used by a whole new group of people, high net worth, sure, but using liquid digital assets, specifically Bitcoin.
Okay, so our mission today is to really understand this shift. We need to break down the BBB playbook, look at this surprising new type of wealthy person that's creating what we're talking low-income millionaires.
Sounds like a contradiction, doesn't it?
It does. And we need to get into the nuts and bolts, the actual financial tools like the Bitcoin line of credit, the BLOC, that make this work for, well, maybe even everyday savers. Let's start with what the Lava team shared about their users.
Yeah, when you look at who's actually using these quite sophisticated borrowing tools, it's not who you'd immediately guess. You'd think, oh, it's the big VCs, the Wall Street quant.
That's the expectation, right? But the data, well, it points to this different archetype. Low income, high wealth.
Which is just wild.
Think about it. 20 years ago, if you went to a bank asking how to become a millionaire, the answer was always about your income. Earn $500,000 a year, start a massive company, have some huge exit. It was all income statement focused.
But Bitcoin, when combined with just, steady saving, seems to change the whole equation completely. It shifts the focus away from how much you make the income statement and puts it squarely onto how much you hold the balance sheet.
So that brings us to the teacher example you hear about.
Ah, yes, the teacher. It's almost the classic case study now. You've got someone, respectable job, probably making less than $100,000 a year. Not a high flyer financially in the traditional sense.
But disciplined.
Extremely disciplined. Over the last 10 years, maybe longer, they just steadily put their extra savings into Bitcoin. Treated it like a savings account, really. Well, now that same person could be sitting on, say, $10 million or more in Bitcoin net worth. It's staggering.
And it's not like they were day trading or taking crazy risks.
No, not at all. It's consistency. Behavioral finance tells us this works, right? Think about civil servants. They often retire comfortably because they live below their means and save diligently. Bitcoin just puts that slow, steady strategy on hyperdrive.
Because it's linked to this incredibly scarce, rapidly appreciating asset.
Exactly. And there's another huge piece here. Access to capital. The old system, the banks, they underwrote you, the borrower.
Which meant bias could creep in, right?
Yeah.
Based on your job, where you live, whatever.
Absolutely. Human bias.
Right.
But in this Bitcoin lending world, the system underwrites the asset. If you have the Bitcoin collateral clean and verifiable, you get the loan. Doesn't matter if you're a teacher or a tech founder.
So it opens doors for people who might have been kind of shut out before.
Yeah, the outcasts of the old system, as some put it. It's much more meritocratic, based purely on the quality of the collateral.
Okay, so to really get why these savers now have this power, we have to unpack buy, borrow, die. It's the old money playbook, basically.
And it has two core goals, really simple when you break it down. 1, keep your exposure to the asset's potential upside. 2, avoid paying taxes right now.
Let's talk about selling first. Why is selling so bad in this model?
Well, it's incredibly costly, financially speaking, if the asset has gone up a lot. Let's say you need $1 million cash. If you sell $1 million worth of your Bitcoin stack first, you immediately lose any future gains on that $1 million worth of Bitcoin. It's gone from your portfolio.
And then the tax man comes knocking.
And then the tax man, capital gains tax, depending where you are, that could be, 25%, maybe more?
Right.
Instantly, your $1 million of purchasing power just became $750,000. Ouch.
Right. So that's the trap. How does Barrow get you around it?
Simple. Instead of selling, you take out a loan, usually a non-recourse loan, using your appreciated Bitcoin as collateral. You get the cash you need tax-free because loans aren't income.
Ah, okay, tax-free cash. And you only pay interest on the loan.
You only pay the interest. And here's where the real magic happens, potentially. It's all about the spread.
The spread.
Yeah, the difference between the interest rate on your loan and the appreciation rate of your collateral. If you're paying, say, 5% interest, but your Bitcoin stack is appreciating at, let's be optimistic, maybe 50% that year.
Wow, okay.
You're effectively capturing a 45% net appreciation spread on that borrowed value, completely tax-free at that moment. You got your cash, and your main wealth source is still growing like crazy.
That's powerful. You see it with billionaires all the time, right?
Yeah.
Like Mackenzie Scott donating billions in Amazon stock.
Exactly. She gave away enormous amounts, but because she held on to the rest of her Amazon shares and they kept appreciating so fast, her net worth actually increased for a while.
It shows the sheer power of just holding the underlying asset.
It really does.
Okay.
But, okay, we have to address the elephant in the room. What if the asset doesn't appreciate?
Right. What if Bitcoin crashes? That's the big risk, surely.
It absolutely is. Anyone borrowing needs to understand that volatility is part of the game. If the price drops significantly, the borrower's equity cushion shrinks, and the lender needs to protect themselves.
So the whole strategy isn't foolproof. It relies on that upward trend over time.
Correct. But the way risk is managed here is very different. And that's where Bitcoin's nature comes in. It involves over-collateralization and, crucially, automated systems.
We'll get to that. But first, the die part. The morbid bit.
Yeah, the die phase. It's the ultimate generational wealth transfer trick. It's called the stepped-up basis.
How does that work?
When the owner of the asset passes away, their heirs inherit the asset. But the cost basis, the original purchase price for tax purposes, gets stepped up to whatever the market value is on the date of death.
So all the capital gains that built up over decades?
Poof, wiped out for tax purposes. The heirs can then sell a portion of that inherited asset, completely tax-free at the federal level currently, use that cash to pay off the outstanding loan.
And keep the rest of the fortune intact, ready for the next generation.
Exactly. It makes the never-sell philosophy work across generations. It's a cornerstone of how families like the Rockefellers or Rothschilds preserved wealth.
So why is Bitcoin so much better suited for this BBD strategy than, say, real estate or private stock? You mentioned friction earlier.
Right. It comes down to what lenders hate, what they fear most.
Yeah.
Friction and illiquidity in the collateral.
Makes sense. Like with a house, if the borrower stops paying.
The bank's in for a nightmare. Foreclosure can take, 18 months, sometimes longer. It costs tens of thousands in legal fees, property upkeep, realtor commissions.
And they have to physically secure and manage the asset. Then sell it, maybe in a down market.
Exactly. It's slow, expensive, and uncertain. All that friction and risk means higher interest rates for the borrower.
And private stock.
Similar headaches. How do you value it accurately and quickly, especially in a crisis? Are there lockup periods? Shareholder agreements restricting sales? It's often highly illiquid. A lender might get stuck holding it.
Okay, so compared to that, why is Bitcoin pristine collateral?
Because it eliminates almost all of that friction and illiquidity.
How so?
First, the collateral isn't somewhere the lender has to chase. It's locked in a secure, multi-signature digital vault, often under the lender's partial or full control from the very beginning. Over-collateralized, too.
So no costly legal battles to seize it.
None. Second, and this is huge, Bitcoin is arguably the most liquid asset on the planet. It trades 247, 365 days a year on exchanges all over the world.
Meaning if there's trouble, the lender can react instantly.
Instantly. Automated risk management becomes possible. They don't have to wait for markets to open or find a specific buyer. This dramatically reduces the lender's risk.
And lower risk for the lender means?
Lower interest rates and easier access for the borrower. It's a direct translation.
Let's get into those risk mechanics then. You mentioned over-collateralization. The loan-to-value ratio, LTV, right?
Exactly. LTV is super simple. It's just the loan amount divided by the value of your collateral.
So if I borrow $50,000 against $100,000 worth of Bitcoin,
your starting LTV is 50%. That other $50,000, that 50% buffer, is your safety cushion. And the lenders too.
and that ratio changes as Bitcoin's price moves.
Constantly. If Bitcoin goes up, your LTV goes down. That's good. More safety. If Bitcoin goes down, your LTV goes up, which signals increasing risk for the lender.
And if it goes up too much, triggers start hitting.
Precisely. There are usually two key automated levels programmed into the system.
Okay, what's the first?
The first is the margin call threshold. Let's say it's set at maybe 60% or 70% LTV. It's a warning shot.
Like, hey, your cushion is getting thin.
Exactly. The system alerts you. You need to either add more Bitcoin collateral to bring the LTV back down or pay down some of the loan principal.
And if you don't, or can't, and the price keeps dropping.
Then you hit the second, more critical level,
Mm-hmm.
the liquidation threshold. This might be set around, say, 85% LTV.
And at 85%, what happens? This sounds like where things could go wrong for the borrower.
In the old world, yes. A bank might panic and liquidate everything. But with Bitcoin, because it's perfectly divisible,
You don't have to sell the whole house.
you don't. The system performs what's called automated fractional liquidation. This is genius, really.
How does that work?
The system doesn't dump your entire $100,000 worth of Bitcoin. It calculates precisely how much needs to be sold right now to bring the LTV back down to a healthy level, maybe that initial 50% or 60%.
So it might just sell like $5,000 worth.
Exactly. Just enough. It happens instantly, automatically 204/7. The lender's capital is protected. The risk is managed immediately.
And crucially, the borrower still holds the vast majority of their Bitcoin.
Right. Their main stack is preserved. The BBD strategy isn't totally derailed by volatility. It's managed surgically.
Okay, so that combination, the over-collateralization, the 204/7 liquidity, and this automated fractional selling, that's what makes it work, even for big institutions.
That's the trifecta. It makes the risk manageable and quantifiable in a way that's just not possible with, say, a warehouse full of art. Now, the early products in this space were often structured almost like mortgages. Fixed terms, required payments.
A bit rigid if you're trying to live the never-sell life.
Exactly. But the evolution led to something much more flexible, really designed for financial freedom. The Bitcoin line of credit, or BLOC.
The BLOC, how's that different?
It's built for that person we talked about, maybe the angel investor, the early retiree, someone whose wealth is on the balance sheet but doesn't have that predictable monthly paycheck.
Gotcha. What are the key features?
Well, there are three main things that make it so flexible. First, open terms. The loan can stay open pretty much indefinitely as long as you manage your LTV. That fits perfectly with never sell.
No looming repayment deadline. Nice.
Second, flexible repayments. This is big. There are generally no required monthly payments. The interest just accrues, added to the loan balance, secured by the collateral.
So you don't need cash flow to service the debt month to month.
Correct. You can let it build up if needed. And third, a fixed rate. These platforms are competing, driving rates down. You're seeing rates pushing towards, 5% or maybe slightly higher now, but fixed. Compare that to a credit card at 25%.
It's not even close. So give me a real-world example. That angel investor.
Right. Let's say she needs $1 million.
Okay.
Maybe to buy a property, maybe invest in another startup, but she knows she's got a big payday coming in, say 2 years, maybe stock options vesting. With a traditional loan, she'd be stressed about making that $6,000 monthly payments. With BLOC, she draws the $1 million, lets the interest accrue for 2 years. Then, when her liquidity event happens,
Pays it all off in one go. Principal plus the accrued interest.
pays it all off. And the entire time, her main Bitcoin stack, it was sitting there, hopefully appreciating, completely untouched. She had full upside exposure.
That offers incredible optionality. Bridges the gap without forcing a sale.
That's the word, optionality. It's the ultimate luxury that wealth provides, and the BLOC makes it accessible without messing up your core holding strategy.
And then there's the final piece, making it usable day to day. The Lava Card or similar products.
Yeah, this connects the high-level strategy to, buying groceries. First, users can automate the saving part, divert part of their paycheck directly into Bitcoin, often with zero fees, constantly building the balance sheet.
Stacking sats automatically.
Stacking sats. Then when you swipe the card at the store, online, wherever what happens.
It doesn't sell you Bitcoin.
Right. No. It instantly draws against your available BLOC credit limit. So the purchase is funded by borrowing right at the point of sale.
Wow. Okay. Seamless. You don't have to log in, request a draw, wait for funds.
It's instantaneous. You live your life funded by borrowing against your appreciating asset.
So the loop is get paid dollars, convert to Bitcoin, hold Bitcoin, borrow against Bitcoin for spending, never sell the Bitcoin.
That's the loop. You strengthen the balance sheet continuously and use credit, hopefully low interest credit, for consumption. We heard about that client services guy buying a Porsche.
Yeah, you got to add the disclaimer there. Borrowing for a depreciating asset is usually not the smartest financial move.
Absolutely, big disclaimer needed. But the point is, the capability was there. He could access the funds to achieve his goal without selling his primary asset. He didn't break the cardinal rule.
So wrapping this up, this deep dive really hammers home a simple, powerful lesson that seems to define this new generation of unexpected millionaires.
Stack Bitcoin, save it, never sell it, borrow against it when you need liquidity.
Yeah, the whole game seems to shift. It's less about maximizing your income statement, your salary slip.
And much more about strengthening your balance sheet. What you own, what you hold for the long term, that's where the power lies now.
In these hunting platforms, their success is actually tied to you not selling, isn't it?
It absolutely is. Think
Yeah.
about their business model. They succeed if you hold more Bitcoin at the end of the year, partly because you use their service to borrow instead of selling during a dip or when you needed cash. Their incentives are aligned with saving, not trading.
Which is a refreshing change from a lot of finance.
It really is. It's built around promoting long-term holding and saving.
Okay, so here's the final thought we want to leave you with. If this strategy, buy, borrow, die, essentially just holding appreciating assets and borrowing against them, is the most proven way the ultra-rich build and maintain wealth.
And if technology, specifically Bitcoin and platforms like Lava, are now making the strategy accessible to anyone disciplined enough to save.
Then what does that mean for all the traditional financial advice you've heard? Things like obsessively paying down your low-interest mortgage as fast as possible, or focusing only on climbing the W-2 career ladder.
Does the existence of liquid, pristine collateral that you can borrow against cheaply change the fundamental rules of building wealth? It's something definitely worth pondering.
It really challenges those old assumptions. Lots to think about there.